What's up, everyone? This is Peter Neal from GSP REI, and you're listening to the Real Estate Investing Onpoint podcast. This podcast is designed to help both active and passive real estate investors take their real estate investing game to the next level so that you can grow a successful real estate investing business or find out what to look for when you're investing passively in a real estate investment business. Let's get right into it. You like a fishing rod? Is that what you said? Like
fly rod. Yeah.
I don't know what that is. When I grew up,
Fishing.
Shore. We went down the shore. We'd fish for like off the shore down the Jersey Shore, catching like little sharks. I never went out to a pond or a lake like that.
That's surf fishing.
Surf fishing. Yeah. That's it. All right, let's get started. Hello and welcome to another exciting edition of the Real Estate Investing Onpoint podcast. I'm Peter Neal, here with Ron Lockhart and Wade Carroll. Episode hasn't even started and we're already having a fun time. What's going on, gentlemen?
We got a little snow here today.
Yeah, we did. What about that? It's sticking too. It's on the ground and the trees. And is it going to be a white Christmas? Is that?
I don't know. We've had snow 3 times already this week.
Yeah.
We didn't have snow once last year.
Oh wow, really?
Yeah, but it was 50 degrees by the end of the day yesterday. So
yeah, we'll see. Wade, you're probably getting a lot of snow out your way, or has it started yet?
It's opening day up in Whitefish today, so first day of the ski mountains open.
Okay.
So
okay. When you're not there, what the heck?
Yeah, well, work. I won't be there Saturday either, which sucks. But
is that so? What
I got
are they?
My skates waxed though.
Oh, there you go.
So I'm ready.
Is opening day? Is that usually a pretty big deal? A lot of people come out.
Yeah, usually a lot of kids skip school. Some schools do half days, but we've been worried about the volume of snow. It's been pretty low. I was worried they wouldn't be able to open today, but we got like 18 inches last week. So,
wow.
I guess that was enough. 53-inch base right now.
Wow, that's amazing.
Do you ever skip school?
Oh man, all the time. The key is you got to be tight with the attendance lady.
Absolutely.
And that's how you pull it off.
Yeah.
But yeah, we would wake up at 6, check the snow report and Telluride. And if it was good, we're throwing the skis in the back of the truck on the way to school. Yeah.
I had perfect attendance up like grade school and high school. Never skipped a day. Well, my mom was a teacher, so there was no skipping school.
That's a bummer.
Yeah, it didn't happen. So, what do you mean the attendance lady? What? Because we had like in our school, every period took attendance, so there was no. I mean, you could be there for homeroom, but you also had to be every single one, every class you took, they took attendance, and that would make its way down to the office, you know.
Yeah, but if you don't show up for homeroom, there's an attendance lady in the office, and they let her. She takes the notes when people are sick or the calls in. Our attendance lady, her name was Mrs. Thomas. She was the nicest lady, and I used to call her and say, "Mrs. Thomas, I'm really not feeling well today." She said, "Honey, you just stay home. You get some rest."
Ferris Bueller right there.
I'd be at the movies.
9 times. So did you get counted as a day off, or like they would count it as you missed a day, right?
I was sick.
Okay.
She marked me as sick.
Oh, okay. And not like what is that? Is it truancy? What do they call that when you don't go to school?
It's an unexcused absence.
Ah, there you go. Okay.
I don't think I ever had any unexcused. They were always excused.
Gotcha. Okay.
Yeah.
So, what you into a white Christmas? Are you guys? What's your thoughts on that? You like to see snow coming down, and you wake up to it.
Absolutely.
Yeah. I feel like owning real estate has changed my opinion on snow. When I was little, I actually just had this conversation with someone earlier today. Yeah, snow, it's exciting. But like, yeah, you own property, and then you think about shoveling and slip and falls and all that kind of stuff. Ron, what's your thoughts on that?
I think if you set up your lease the right way, you're not out there shoveling it yourself.
Yeah, no, I know what you mean. That's something I kind of learned early on. With the duplex, you don't know, who should you make responsible, who doesn't want to be responsible, that kind of thing. So it's like important to have a tenant that is willing to do it, and you can work something out, and make it worth it for each party.
Yeah, give them a small reduction on rent each month to do certain maintenance items.
Yeah, that's what I do. So looks like it snowed on your face there, Ron. What you're growing the beard out a little bit there, or
A little bit. We'll see how long it goes. I have to go to a Christmas party on Saturday and see if my wife lets me keep it.
Okay, I'll say. So Christmas party. What do you have to do for the Christmas party? Are you bringing gifts? Is there a white elephant or?
No, there's 3 this weekend. There's 1 Friday night and 2 Saturday night, and the second one is a combination Christmas party, 40th birthday party.
Gotcha.
I don't want to go to any of them.
I always feel bad for the people who the birthday falls right around the Christmas time. My dad's birthday is January 12th. Yeah, it's you don't get treated the same, right? When you have the Christmas and you got the birthday, you're not gonna get as many presents no matter how hard the parents try, right?
I don't know. My daughter's December 27th, and
Ooh.
she seems to make it out every year.
She's making out double.
Yeah, so I don't think she ever suffered. But you can ask her that question.
We'll have to have her guest on the podcast. Life with Ron. She can answer a lot of questions for us.
Yeah.
So Wade, you're coming off of a big Heckham HUD trade. Bids were due. We talked about this last week. Give us an update on what's going on there.
Yeah, they sent out, or they made all the award calls yesterday. And I would say, I mean, we're happy, right? Because you don't want to get skunked. And I've been skunked before. So you always go into the auction with a bit of trepidation. I'm seldom confident. That bothers me. It's just so.
So clarify for us. When you say skunked, what exactly do you mean, and why aren't you confident?
Well, like, I mean, in 2022, we bid 500 loans in 122. I consider that a skunk. That's
okay.
Less than
that's
1%.
for the whole year. 365.
No, just for that one auction.
Just for that one. Okay.
What's a little surreal, I guess, about that is that 2 months later there was another auction, and same thing, 500 bids, and we won 22 again. So I don't know if because 2 in a row that disappointment is stamped on my head or in my brain, that I don't know. You just never know who's going to show up, how hard they're going to bid. And auctions are a little bit difficult because you're never going to outbid an idiot. And I'd like to think at this level there's not that many idiots, but I don't know. Maybe I'm the idiot because I don't know. But it seems like to me that in an auction, the winner is the guy that cares least about the future. Like, he's only optimistic. Like, he has no concerns whatsoever. Interest rates, appreciation, nothing. And it's hard to beat that guy, whoever it is. I think it's Condor, frankly.
There you go. Calling them out by name. It seems to be
they changed their name, and I never remember it. So
okay.
People know. They always win everything. So
it seems.
But we did okay. We underperformed our average, but we did buy 142 properties, which is.
So, and when will you have the data back and all that kind of stuff to start to make decisions for next go around?
Well, we're trying to get the deposit wire out now, and I'm assuming as soon as they have our money, I'll get a list. but I've not seen it. I don't know what 142 properties we want. So
for the audience, so you buy 142 properties. They're all in the first position. They're all HECM loans. Borrowers deceased on 100% of them, I'm assuming. What does it look like? What do you do from there?
we've already ordered title. We haven't already ordered title. We will be ordering title as soon as we get the addresses. So that's one of the first things we do. Then we dig through it that way. But you send out the hello, goodbye letters, which is odd that we do that for HECMs because we already know that the borrower is not living and no one's in the house. And they're not going to the estate because nobody knows who that is yet. But it's a requirement. So we send those out. But there's several preset dates once you acquire the loans that certain things have to be done, but usually within 90 days we start foreclosure on everybody, and usually that starts bringing the estates out of the woodwork, approaching us, calling because they don't understand or want a foreclosure on the record, and which it really doesn't affect the estate, but it does give us an opportunity to reach out to people. But with the HECMs, it's pretty fast. I mean, you're moving very fast on the HECMs.
So, what else is new? Guys reading any interesting articles or any interesting news or anything happening in the market you think is worth noting?
Anything interesting happening in the markets?
Talk to us, Ron.
I don't know. I mean, I feel like every day I see a new article on single family being the primary focus or a big focus. Single family rentals, whether it be institutional, funds, private equity, whatever it may be. I feel like every day I'm seeing another article. It's really coming into focus more and more. I mean, obviously we've already been focused on it, but it's getting a lot more attention.
It seems like in the last month or so, there has been an uptick in articles around the opportunity in single family rentals. I just sent an email out just before we started recording. It was an article from Moody's Analytics, the superstar of today and tomorrow, growth and opportunity in the single family rental market. Talks about, one of the quotes that I grabbed out of it for the email was, from the ashes of rapid and somewhat unpredictable change, a phoenix has time and again risen single family rentals. So I thought that was a pretty cool thing. It's always, we say it all the time, like you said, Ron, but to kind of see other news sources saying it and providing a bunch of data and research and information like that around why it's becoming more and more of a topic and something institutions are looking at. They've earmarked billions of dollars for it in the scattered site, but also in the build to rent communities. Something that we were talking about, we certainly have an interest in, but yeah, it definitely, I've been saying this forever to our investors, now is the time to invest in single family rentals. And I think, Wade, you brought up a point that was, it seems we're pretty polarized right now. There's some people I talk to who they want to invest. They think there's a lot of opportunity. They're seeing a lot of opportunity either with single family rentals and on the lending side, short term bridge, mezzanine type lending, that kind of thing. But also a lot of opportunity with like the savior capital in the multifamily world with preferred equity deals and things like that. And then you have these other people who are just like, they're just totally on the sidelines 100%. They don't want to really get invested in anything right now. So what's your guys' opinion on this, and where would you say in the scale of aggressive opportunity wise to sit back, do nothing. Something's going to happen here, either from a recession or some major collapse or something like that. I know we've talked about this before, but as more information comes out and as the days go on, it's always interesting to check back in and see what are you seeing today and why do you feel the way you feel. And I'll kind of kick it off too, because neither of you jumped right on that. It just seems like it comes back to demand over and over again. In all of these articles for single family and the opportunity in single family, it just seems like, and we talked about this last week. There was the Freddie Mac research that it came out. It wasn't these Wall Street giants who were buying up single families that massively increased pricing and all. Not that I'm sure that was certainly a part of it, and in certain markets I'm sure that was a part of it. But overall, it was just the low supply, the high demand, the low interest rates, COVID, people working from home, having more flexibility, moving around, looking for more space. Like, there's just been all these factors, but it seems like it just keeps coming back to the sheer demand and the low supply. Because I think a lot of investors are looking for, what do they do right now? I mean, and I think foundationally going back to supply and demand is a smart thing to do when you're looking for, what do you make a decision? Same thing with these preferred equity deals. And I mean, there's demand for those types of deals because people have apartments and deals that need that kind of rescue capital to get them through to the next stage. So what are you guys thinking?
Wait, do you want to go first?
No.
But you were just saying something about build to rent earlier, so I thought you might want to jump that in.
No, I mean, well, we started off, I'm confused because we started off talking about this article. And so I'm jumping all over the place here. But what I thought was quite striking is they pointed to the top performing markets and the bottom performing markets. And that all of your big institutional investors, I thought they said like they're like of the 10 worst performing markets, they're in like 9 of them.
Yeah.
Or maybe all 10 of them or something. And of the better performing markets, they're almost in none of them.
Yeah, they're in 3 out of the 10.
Yeah. So I think that's compelling. They pointed to some, was it like Rochester or something, as one of the top markets. Nobody's in it.
Nobody's in it.
Nobody's there.
No, the top 5, the top 1, 2, 3, 4, 5, the top 5. Yeah, nobody's in the top 5. And just for the listener, we're talking about a Moody's Analytics article that came out September 14, 2023. There was a Fortune article that just came out a week or two ago that referenced this article a lot. And the title of the article is "The Superstar of Today and Tomorrow: Growth and Opportunity in the Single Family Rental Market." And they have a list of the top 10 highest grossing yield SFR markets, and then the bottom 10. And they make it real clear with the way it's presented, with institutional presence in those markets. And they're looks like they're in 9 out of 10 of the bottom, and they're in 3 out of 10 in the top markets. So very, very interesting. When I was reading that was definitely something that stood out as well.
I'm curious how they calculate some of these things, because we're beating all those numbers.
Yeah, when you talk about gross yield and stuff like that. Yeah, I know what you mean.
So I mean, we're beating all these, and I'd say we're beating them handily. But Baltimore's not on here. Neither is Philadelphia.
Yeah.
So anyway, it's curious, but I think it's curious. It's showing then in the top performing that Chicago's in there with the Chicago property tax base. That's very surprising to me, and that also there's institutional investors in Chicago.
Yeah.
From an SFR perspective, that seems really. I mean, I would love to have rentals in Chicago, but man, the property taxes just eat you alive. So
Chicago's come up in a bunch of articles as
yeah,
one of the top markets. And they've been mentioned quite a bit.
yeah.
Yeah, and it was interesting too because Baltimore and Philadelphia and Pittsburgh, which did come up on this, Baltimore and Philadelphia came up on an article that we were throwing around a couple weeks ago,
Right.
and it was more about it didn't have uh, that hockey stick type, it didn't have the massive appreciation and then a pullback. It's been more of that steady growth. Which I think you see in a lot of these mid-Atlantic markets where they didn't have this massive migration of people like the Sun Belt did, so they didn't have this massive tick up in rents and things like that over the last couple of years with COVID. These areas are just more kind of just steady growth in the long term.
We've talked about that a lot, even before. I mean, a year ago, we were talking about that. The markets we were in, that we're invested in, like a Philadelphia or a Baltimore, never had that hockey stick appreciation, and it makes you feel more comfortable seeing steady growth as opposed to, popping up, leveling off, and in some cases pulling back a touch.
Sure.
Yeah.
Yeah. So after reading that, and I feel like we should be. Well, it's good that we're in the markets we are in. It's also good that the big boys aren't there yet. Maybe they won't be, but we should take advantage of that opportunity.
I think it's really hard for the big companies, the big institutional investors to go in to those metropolitan markets. It's different, for a number of different reasons. The management of the assets is different than buying in suburban areas of the Sun Belt. It's two totally different worlds. And there's a lot of articles out there that talk about why the larger institutions focus on those markets like the Sun Belt. The price point from an entry standpoint, the type of product it is. You're seeing more and more build to rent now because they need to do it at a greater scale. It'd be hard to go into a city like Baltimore and buy 15,000 properties. They're heavy rehab properties. They're not, low value add where you just need to put, $15,000 into it. In most cases, you're putting $100,000 where, of your total cost of the property between acquisition and development, you're talking about you're putting 90% of that number into the property. Your acquisition cost is about 10% of it. So
yeah,
it's a completely different model.
I think it's something that we're just at the cusp of it now. I think it's the beginning stages. I think there's like 3 institutions that have an affordable focus. So when you look at like the big players, Invitation Homes, Progressive, American Homes for Rent, they Tricon, they certainly do not have a affordable workforce housing type focus. Now there are just a handful. I think it's less. I think it's 3. I think it's less than 5 that have 10,000 units all within that kind of affordable and workforce housing. Where property values are under 200, 250, rents are under around 1,600 or so. So yeah, it's certainly not a space that they've gravitated towards as they've initially got into single family, but I think that's where the opportunity is. So I think there's going to be more and more of a focus on it in the years to come. And I've been reading articles and having conversations with some of these more institutional and private equity, backed type investors and investment platforms. And I don't think there's an institution in the real estate world that hasn't in some way looked at single family in the U.S. It just seems like if you're investing in real estate institutionally, single family is one of those things that it's on everybody's radar right now, whether they're doing it or not. Chances are they've researched it and are looking into it. Would you agree with that, Wade, especially since you have your capital partner on the note side, and you have these kinds of conversations, and it seems like over the years SFR has come more into the forefront, and they're more open to it than they were a couple years ago.
That's hard for me to answer because I've only ever done SFR, like outside of a few hotels, but clearly it's more commonplace. So I guess it would have to be true, because when we're first raising capital, 2005 or so, talking about a fairly large rental portfolio of single families, that was unusual. Certainly unusual pre-2008, right? So, but yeah, I would agree with that.
2008 kind of created the opportunity, and we've talked
exactly
this a bunch of times. I mean, that's where the major shift took place. I just want to go back to something where, when you talk about affordable housing, everybody's definition of that is not the same. When you hear discussions about affordable housing in the media, on the national news networks, I remember seeing a piece not that long ago. Lennar Homes was starting what they called an affordable housing development in Texas, and the price point was over $400,000. Yeah. So, a lot of companies, when they're talking about, we're addressing affordable housing, you're not really addressing affordable housing. It's like, I guess to a certain extent, it's a relative term. It's affordability. I think there was an article out there recently that said to own a home today, when interest rates hit 8%, you needed the combined household income, I think, had to be over $100,000. Like that's where affordability is going. But truly, when we look at our definition of affordable housing and workforce housing, which is really the biggest problem, it's not $400,000-$500,000 homes. It's homes that are $150,000 to $250,000. Like that's where our biggest gap is. Another reason why the rental market continues to be strong and getting stronger, because we're just not filling the void at all, or I shouldn't say at all, in any meaningful way.
I don't know that I've ever considered a $400,000 house affordable, but yeah, back when you could get interest rates at 2.5% and 3%, you're like, well, maybe it was affordable. Yeah. It's not anymore. Whatever it was.
Yeah,
it's crazy.
One of the stats I've been talking about a lot lately, and I have it actually written next to me. Less than 4% of new homes constructed are sold for under $200,000. So when you think about
what you said, 4%,
less than 4% of newly constructed homes are selling for under $200,000. So, and that's looking at nationwide data. I mean, so you think of some of these markets, they have like no homes under 200,000 that are being constructed. So I've kind of been saying it, in conversation, where it's like single family affordable workforce type housing, properties under 200, under 250,000, starter homes is like another kind of word that you'd hear thrown around. Like these are becoming like a rare asset. Like they're not making any more of them. So the opportunity is to revitalize existing, and there are certainly areas where you can find blighted properties and properties that need that full kind of renovation. And to Ron's point, from an institutional perspective, that certainly takes it takes a certain knowledge and a certain skill set and a certain team to be able to go into those types of areas and buy it enough volume and then revitalize, lease and manage, or strategically sell assets off and things like that. So which can kind of lead to the question, like, and we've talked about this before, but what do you think it is that, like, that you need to have in order to be successful in that space? Like, because what is it that the institutions would you think are lacking in, or why they don't go after that, or what it may be, and what is it like that we do at GSP that's different? Ron, I asked the question to you.
Well, I mean, I think, for institutions to do anything, they need to, for the most part, they need to be able to do it with scale. And their timelines are very different than I think a lot of other people and other companies when they're looking at an investment. So to execute in those markets at scale is tough. It's not like they can go buy, 50 acres, in a metropolitan area. It doesn't work that way. It's hard to get enough contiguous properties to have something make sense. So I think that's a roadblock right out of the gate. It's also the cost, to do it at a smaller scale. I don't think it really makes sense for them. Because we're vertically integrated, we handle our construction, we handle our property management, we handle our asset management all in house. Our margins are better. It costs us less to do the same project that it would cost somebody who isn't handling those things in house. So, I think that's where we have an advantage. It also allows us, we don't have to go buy $100 million of property right out of the gate, or come up with a development plan for $150 million right out of the gate. It's just very different.
And a lot of those big firms had mandates for what type of property. A lot of them, they only wanted slab. They wanted like 1984 and newer, stuff like that. Well, not too many 1984 or newer properties in downtown Baltimore. So it's very, their own internal box was so restrictive that it pretty much put them in the South. The Floridas, the
That's
Texas,
a good point.
the Alabamas, the Georgia.
Yeah, I actually kind of leads into the question I was going to ask for you, Wade. It was we were talking about built to rent communities, and I think that's one of the reasons institutions have gravitated towards that, is kind of what Ron's saying. They can go out and they can buy a tract of land, they can develop 100 units or whatever it may be, so they can spend more money and they can have that scale. So it kind of fits that side, but it also fits the side that you're talking about right now, where now they have a newly constructed home, less maintenance, repairs, and it fits in that box that they have. What is it? We've been talking about built to rent communities and the opportunity there. It sounds like there's built to rent communities. I've read an article recently like that. It's going to have an effect on just because now more home builders are building build to rent communities instead of build for sale properties. So it's going to be there's going to be more product that comes online, but it's going to be more of the rental product and not so much of the sale product. So that's kind of an interesting dynamic there. What attracts you to that space, Wade?
Well, a lot of those same things, but I mean, it's one thing to talk about build for rent, in buying a large tract of land, but I like the idea on vacant blocks in downtown Baltimore, places right like that. There's, the land banks down there will almost give you that kind of property. So I like the idea of just stacking them all up on one half of a block, however many you can fit, because they're not going to be there. These institutional competitors, they won't be there. Now, because we've talked about doing this in the Carolinas, they're probably there. They're likely there.
Definitely.
And not that we can't try to compete with them, but I just feel like we have a little bit of a bird's nest on the ground in some of these markets that we're in, where the big guys aren't playing, and they may never play. So that's why it's attractive to me. But
yeah, I think that makes sense, and that's definitely a different angle when it comes to kind of not wanting to compete or in the institutional space, or trying to find something different and really go to where the demand is, and markets that we're already in and have some, have those boots on the ground and have the experience in those markets.
Well, and if you think about the construction complexities of what we do, where you're buying a $30,000 unit and spending 90 grand on a renovation, that's a lot more complicated than new construction. New construction, I've never done new construction, so I'm a little bit ignorant, but I'm sure Ron can back me up on this. Most things are predetermined in new construction. You've already got all your bids. You know what the concrete's going to be. You know what the dirt work's going to be. You know how many sticks you're going to need. Versus when you break into a home that was built in 1919, you have no idea what you're going to find when you start tearing out walls, and I'm assuming that's a lot more complicated to do a big, heavy renovation that includes new wire, new plumbing in an existing structure versus doing it from the ground up. There's a lot more unknowns in a heavy renovation than new construction. Am I wrong?
No, I mean, new construction is more predictable. And it's not like we're talking about a custom build here that's $5 million, where, the house may be 10,000 square feet. We're talking about very basic construction. It's predictable. It's cookie cutter. To your point earlier, you're building these on slabs. You're not excavating big basements. In some cases, you can even utilize modular, when you're doing this, when you're basically building a box. So yeah, it's a lot easier. It's a lot more predictable. You tend to have a lot less surprises for sure. When we look at buying one of those houses from the 1919s or the teens or the 1920s, we're assuming you have to do everything, but it doesn't change the fact that you run into surprises all the time.
Yeah, that was the first thing that came to mind for me, was as long as you can get it at the right price point and you can go under the assumption that everything needs to get changed, then that's an advantage to buying property like that. As we're talking about institutions and the opportunities and the single family space and all, there was an article we passed around a little bit ago. Ron, I know we talked about it. Wade, I'm not sure if you saw this one come through. It was about an institution that had become credit worthy. It was rated in some of these credit bureaus and all, and they were doing like a sublease. They were doing a lease and then subleasing all of their properties to the individual tenants, and then packaging it up and selling it to an institution or a large investor as single family, as like a triple net opportunity. Remember this article, Ron, we talked about?
Yeah, they basically had a master lease on the whole portfolio.
Yeah, so I thought that was a very, very interesting and new angle to the SFR space, something I've never seen done before. What's your thoughts on that? Do you think that's something? And Wade, did you see that article? Or I know you've been pretty busy the last couple of weeks. You might have missed that one.
No, I didn't. But when we did when we accumulated our 600 rental houses in Houston, they were all on a master lease. We did the same thing. We made some mistakes in it, but that's what we did too. We sold the properties and then leased them all right back. Took over the management.
So what's your like what? And I'm looking at this from selling it to an investor. I mean, so packaging up that portfolio, then selling it to the investor. That investor is looking at it as, now I have a triple net. This is a triple net opportunity here, and they're going to take care of everything, and anything they make above, the whatever their lease is. I mean, that's theirs to keep. I mean, that kind of thing. Right. If that makes sense. So, what's your thought? You think that's going to be a game changer in the SFR space and in the institutional space when it comes to single family portfolios? You think, what was your initial thought on that? Because I thought that was a pretty interesting. Institutions and those types of investors love triple net, and they don't have to do anything, and they have one of the things I think turn off to single family sometimes is the tenants, and are they credit worthy or not? And we do a lot of Section 8, which is something we like, and we know our investors like. When you have a lease, with that's federally, the federal government's paying the rent. So something like this is this changes up the dynamic a little bit. So what's your thoughts on it? You think that's here to stay? You think you're going to see more of it? What was your initial take?
I think there are benefits to it. Oh, sorry, go ahead, Ryan.
I was just going to say, I think you've got to, first of all, it has to make economic sense, right? So I think whoever's selling the portfolio and is responsible for that master lease, you better be, I think you have to be in a pretty conservative market to do that. My guess would be their margins aren't fantastic. They're looking to they're acquiring these properties. They're probably redeveloping them to a certain extent, stabilizing and selling them. My guess is the margin isn't huge, and it's definitely not huge between what they're making or for what they're making over and above what they're paying the investor. I could see that with large companies with lower return hurdles. I just have a hard time believing that the margins are real good on that. And again, I think you got to be in a very conservative geographic market as opposed to something that could be perceived as risky. Because I think despite the creditworthiness of that company, the investor is going to want to be comfortable with what the geography of these properties are. My guess is that the returns aren't fantastic, but I could be very wrong about that.
You mean for the operator?
For the operator.
Well, I would think if the operator, if they can get a pretty low cap rate, being that it's a triple net opportunity, and the investor doesn't need to do anything at all, that they could be getting a pretty favorable price on the portfolio compared to if they just sold it as a portfolio or something like that.
Yeah, I think they're making some decent money on the front end. It's the ongoing.
Yeah, the ongoing. Yeah, the difference between what they're collecting and what they need to pay on their master lease, and then I think in the article it said that there would be increases in that lease over time and all. So they're making some assumptions around the markets that they're in, and that the rents are going to keep increasing and all that kind of stuff. So that's a good point.
You also got to take into consideration whoever has that master lease to be credit worthy for something like that. You're limiting the pool of players. If you're doing that with any sort of size, say it's, I don't remember how many properties were in that off the top of my head.
I think the one that the article talked about, I think it was pretty sizable. I think it was $20 million portfolio, something like that.
Yeah.
But they also talked about doing smaller portfolios as well.
Yeah. But to be responsible for that, somebody's creditworthiness has to be up there.
Sure.
Yeah. Because we're not even talking about obviously financing there. That's like what somebody would look at for a big anchor tenant or something like that.
Yeah. What are you thinking, Wade? Well, you look like you're in deep thought there.
No, I feel I should have read the article. I'm not sure which one you're talking about. I was scrolling through my text trying to find it.
No, I think it was probably 2 weeks ago that I sent that over.
Okay. But I'm assuming it was a situation where the operator was paying the investors a fixed rate of return, right? and then he had a
No,
master
The,
lease.
no, they're selling. The operator has a master lease, and they're selling the portfolio to an investor, and then so that investor now owns that portfolio, and the portfolio has a master lease with the operator. The operator is going to manage, do all the tenant, all leasing, changeover, turnover, all that kind of stuff. Anything that they collect above and beyond their master lease, they pocket that. I don't know if I would think that would be it. You know what I mean? So they're probably getting a favorable price, I would think, on the portfolio, selling it as a triple net. I'm not sure what the cap rate was, but I would think it would be favorable. And then,
well, well, just, I mean, here's something else to think about. If, being a triple net lease, the insurance, we're in a real estate interest or insurance environment that's becoming somewhat more unpredictable depending upon where you are geographically. Like, anything coastal, Florida, like, I mean, it's going through the roof. You've got to be pretty confident in what's going to happen from a tax standpoint, with property taxes. Are there going to be a lot of assessments? I mean, when it's a triple net, and also, I mean, how many years was the lease? Do you remember?
I want to say 20.
I mean, that's a long time.
Yeah.
So, there's a lot of variables in there over that 20-year period.
Sure.
So, I mean, I think that's got to be for a pretty specialized group of operators. For the investor, if the economics are good, sure, it's good. They're eliminating a lot of that risk by, like their variables for the insurance and the taxes and whatnot. That all falls on the operator. I just, I'd love to know what the actual cap rate was.
Yeah, we'll have to look it up. I didn't want to try digging for it now, but I'll have to look it up, get to the article, and get some of those specifics.
There's a lot can go wrong there for over 20 years.
Sure.
Ours was we paid the investor a fixed rate, and then we did a master lease back over all those properties. And but the term was much shorter. We gave him a 3-year and a 5-year option, and we would advance any construction costs, any make readies, any maintenance. We'd advance it all. But the idea was at the end of the 3 or 5-year term, they'd refinance and remunerate our costs. And the problem was the first 5-year stint was 2008. So the first handful of guys that were due to do a refinance, they'd already filed bankruptcy because of whatever other real estate they had going on in California or Nevada or whatever. So it became a big, ugly mess on our side because at that point we didn't really control the assets outside of a master lease, but all of our guys were getting foreclosed on through their other business activities, I guess. But so we never got repaid. We'd advanced millions of dollars over a 5-year period on 600 units and disappeared. So yeah, there's some risk to that for sure.
It's definitely an interesting concept, and it kind of, I think, speaks to the demand and the opportunity in the SFR space that this is even a thing, and that potentially another vertical to get in. And there's been a lot of new verticals, and we've looked at some of them when it comes to investment platforms and things like that, and fractionalizing and all. But I feel like we've definitely talked about a lot of topics for today. Let's pick it up next week, and maybe we'll talk about some of those other SFR opportunities and platforms when it comes to funds and fractionalization and private lending and let's talk about all that kind of stuff next week. I think that'll be a fun conversation. So we always appreciate you joining us and taking the time out of your day to listen. Until next time, for myself, Ron, and Wade, we appreciate you. And if you have any questions or need anything from us, always feel free to reach out. So until next time, thank you very much. There you have it. Thank you for listening to the Real Estate Investing On Point podcast. Be sure to subscribe and join us live on one of our virtual meetups. You can find more information on our website at gsprei.com. That's gsprei.com. Thank you again, and God bless. We'll look forward to catching you on the next one.